Hi, I'm Andy Temte, and welcome to Money Lessons. Join me every Saturday morning for bite-sized lessons that are designed to improve financial literacy around the world. Today is January the 24th, 2026. Last week, we explored bond mechanics, face value, coupon rate, and maturity date. We discovered the crucial inverse relationship between interest rates and bond prices. When rates rise, bond prices fall, and vice versa. We watched our example $1,000 face value bond with a 5% coupon drop to $926 in the open market when market rates climbed to 6%. But I used the word yield several times without fully explaining it. Today, we're going to unpack this essential concept. Understanding yield and the different ways to measure it is fundamental to comparing bonds and evaluating your true return. So, what is yield? At its simplest, yield is your return on investment expressed as a percentage. But here's what makes bonds interesting. There are several ways to calculate yield, and each one tells you something different about your investment. The confusion arises because bond prices fluctuate while coupon payments remain fixed. When you buy a bond at a price different from its face value, the stated coupon rate no longer reflects your actual return. This is the primary reason why we need multiple yield measures. So let's start with nominal yield, or also known as the stated rate. Nominal yield is simply the coupon rate, the interest rate printed on the bond. Our example bond with a 5% coupon has a nominal yield of 5%. It will pay $50 annually on $1,000 face value, period. Nominal yield never changes, regardless of what happens to the bond's market price. If you buy that bond for $900 or $1,100, the nominal yield remains 5%. The bond still pays $50 per year based on its $1,000 face value. This is why nominal yield alone doesn't tell you much about your actual return. It ignores what you paid for the bond. Now, let's talk about current yield. Current yield accounts for the price you paid for the bond in the open market. The calculation is straightforward. Divide the annual interest payment by the current market price. Using our 5% coupon bond paying $50 annually, if you paid $1,000 or par value, your current yield is 5% or $50 coupon payment divided by $1,000. If you paid $926, or the discount that we talked about last week, your current yield is 5.4%, or the $50 coupon divided by $926. Alternatively, if you paid $1,082, or the premium that we talked about last week, your current yield is 4.6%, or $50 divided by $1,082. Current yield gives you a better picture than nominal yield because it reflects your actual investment, but it still misses something important. It ignores what happens at maturity. So let's talk about the most common yield measure, which is yield to maturity, or YTM, also known as total return. This is the most complete measure of return. It accounts for three things: the interest payments you'll receive, the price you paid for the bond, and the gain or loss when the bond matures at face value. Consider our bond purchased at a $74 discount, meaning you paid $926 for a $1,000 face value bond. You'll receive $50 annually in interest payments, but you'll also receive $1,000 at maturity, which is a $74 gain over your purchase price. Yield to maturity captures both the interest income and this capital gain, expressing them as a single annualized return. For our discounted bond, the yield to maturity is 6%, the market interest rate we used to calculate the $926 price in last week's lesson. Now, the math involves present value calculations that professionals handle with computers and financial calculators, but the concept is intuitive. Yield to maturity tells you your total annualized return if you hold the bond until maturity. The reverse applies to premium bonds. If you paid $1,082 for our hypothetical bond, you'll receive $50 annually, but lose $82 at maturity when you receive only $1,000 in face value. The yield to maturity of 4% reflects this capital loss alongside your interest income. Now, some bonds are callable, meaning that the issuer can repay the principal before the maturity date. Companies typically call bonds when interest rates fall. They can retire expensive old debt with high coupon rates and issue new bonds with lower coupon rates, reducing their interest expense. Yield to call, or YTC, calculates your return assuming that the bond is called at the earliest possible date. For premium bonds especially, yield to call is often lower than yield to maturity because you'll receive your principal back sooner than you expected, giving less time to collect those attractive above-market interest payments. When evaluating callable bonds trading at a premium, experienced investors often focus on yield to call rather than yield to maturity as a more conservative estimate of return. Now, let's talk about the hierarchy between these yield measures. This is how everything ties together. The relationships between nominal yield, current yield, and yield to maturity, they follow a predictable pattern based on whether you bought at par, premium, or at a discount. At par, meaning that you paid face value, all three yields are equal to each other. Your 5% coupon bond bought for $1,000 has a nominal yield, current yield, and yield to maturity all of 5%. At a discount, meaning you paid less than face value, yield to maturity is greater than current yield, which is greater than nominal yield. You're earning the stated interest plus a capital gain at maturity. So for our $926 bond, yield to maturity of 6% is greater than current yield of 5.4% is greater than the nominal yield of 5%. At a premium, where you paid more than face value, the relationship reverses. Nominal yield is greater than current yield is greater than yield to maturity. You're earning the stated interest but facing a capital loss at maturity. For our $1,082 bond, nominal yield is 5%, current yield is 4.6%, and yield to maturity is 4%. Understanding this hierarchy helps you quickly assess whether a bond's price reflects a premium or a discount without doing calculations. So, why does this matter? When comparing bonds, you must compare the right yields to get an apples-to-apples comparison. Since coupon, term to maturity, call dates, default risk, and other factors can vary wildly between bonds, understanding yield measures is a critical component of any financial literacy journey. The financial news and bond quotes typically report yield to maturity because it's the most comprehensive measure. When you see in the media that 10-year Treasury yields rose to 4.5%, that's yield to maturity, the total return investors demand for lending to the government for a decade. Next week, we'll explore the landscape of bond types. Treasuries, corporates, municipals, and high-yield bonds, and we'll discover why different bonds offer different yields based on their risk profiles. So, until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is Money Lessons. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public good with your friends, your family members, your colleagues, and maybe a neighbor. The show is produced by Nicholas Temte, and we'll see you next week on Money Lessons.